How positive, though, is a stronger pound, particularly for equities?
I think just to pick up on your point, though, about how bad September was, we really should pay attention quite how awful that month was. I mean, UK politics was in utter turmoil, so seeing that almost parity was a kind of a very much a black swan event. It wasn't a sort of an example of longer term trajectory. I'd say now what we have is a bit more normalised and a much more reflective of actually the underlying economic health of the UK versus somewhere like the US. So of course we saw the US be much more protected from the impact of the Russia-Ukraine war because it had much more energy independence versus the UK, where we're very much reliant on that European pipeline for our oil and gas. So what does that mean for equities? Well, you have a bit of a sort of a dichotomy with the FTSE, don't you? Because 70% of revenues come from overseas. So actually a softer pound can be good news, but ultimately you've got to have positive sentiment for the market to do well as also. And so going into 2023, we're actually very cautious on the FTSE. You know, we are on pretty good levels here at the moment. You know, our sort of all-time high is around 7,800 and we're around 7,500 here. We don't think that is where we're going to end up in 12 months' time.
Sure. It's fairly downbeat then, that assessment, right? In the sense that, yes, having run what may look like a little harder now, but is this really just based off economic fundamentals, which, as you said, aren't actually that massive an impact on the equity market? Or what else kind of drags these valuations a lot more in over the next 12 months then?
I think it is the spectre of recession. You know, the fact that we have extremely high inflation, the fact that the forecast now for Bank of England base rate, you know, a couple of months ago they were expecting that to sort of peak in the first quarter of next year and start to come down. Actually, the yield curve now is saying it stays around 4.5% through the year. You know, higher interest rates do have a negative impact on the majority of the equity market. Not all of them. Some of them are, you know, benefit from it, like the financials. But, you know, that very much dragging on equity valuations, and the fact that it's just going to be so much harder for corporates and consumers, and you need people to be spending money to support the equity market.
Yeah. We've seen a lot of action in bond markets over the last week or so, and I think that's been one of the catalysts for the selling we've seen, especially in U.S. tech. What do you think the bond market action is telling us?
I think, again, it's expecting inflation and corresponding interest rates to be higher for longer. We have seen a little bit of a separation between emerging markets and developed markets over the last few months, which is quite interesting. So we've seen signs that inflation is peaking in emerging markets. And of course, they started to raise rates much earlier than we did. So you think about Brazil and Chile, you know, they were raising rates in 2021, whereas actually the US and the UK and a lot of other developed markets were slower to do that. So I do think there is potentially a separation of developed markets and emerging markets, but certainly, you know, bonds look more attractive than they have done in an extremely long time. You can actually get an attractive yield on a bond, whereas for, you know, close to a decade you couldn't do that. So just the fact that it is much more attractive, that yield is much more attractive, the equity market is much more uncertain, is seeing those shifts.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.